The Hedgeless Horseman here. It's March the 20th. I did other recording a couple of days ago. I haven't uploaded yet. I might upload it. But anyway, so I felt like doing another one anyway because obviously a lot of stuff has happened just in the last 2 days, at least in the market. Obviously not much for any specific company at all because most haven't had news out in the last 2 days, but prices have changed. First of all, thanks to the sponsors. Markets right now, gold is rebounding, silver is rebounding. Yesterday was a very red day. I think silver for a while was down like 13%, at least silver futures. I think gold's futures were down like 6%. Miners took a big beating. I think it was one of my I'm not gonna say worst days because that's like implying that something necessarily bad happened. But in terms of paper losses, it was one of the biggest paper loss days, I think, for the portfolio. Or at least, I mean, it's up there at least. I mean, it's like, I don't know, minus 7-8% something for a while. I think one, was down 10%, some of them at least. But again, I don't think that should be the mentality as like, correction, that's always bad. I mean, if you do some value shuffle and actually, or even if you don't do any value shuffle, I mean, if what you own is cheap, if your portfolio is undervalued, they're just paper losses. You might make as much in a year from now as you did or as you would have yesterday, despite the fact that there was a big red day. I mean, it doesn't mean much. It could go back up quickly. Anyway, so yeah, I mean, you can see obviously it looks like it's almost, well, so far correcting sideways, and here we had this big tail, and I mean it looks like there's some resistance or support here, I was gonna say. Kind of the same in silver. I mean, I wouldn't be too surprised, I was gonna say, if silver hit like, I don't know, 55 or whatever, just to have a retest of the obviously very, very long insane breakout. And that's why a lot of people think that given the magnitude of this base, to have it break out and top within 3 months, that to me seems very unrealistic. But of course people look at these peaks, etc., and it's like, yeah, okay, last time it went exponential, sector was dead for 20 years, then, or the second last time, and then the last time it was dead for, well, bottomed out, I guess, one could say here, so 5 years, etc. Is that impossible? No, it's not impossible, but it's we're gonna get to the fact that I don't think you should be fighting the last war. Maybe the fact that it didn't go higher here was ridiculous, let's say. But hey, I mean, since then we had years of deficits, solar panels eating up a bunch of the supply. So it's not like it's apples to apples. I mean, things change, and one would expect that it's a precious and industrial metal, and it's, one could say rather, that it's been the biggest underperformer over the last 40 years. So maybe it's gonna be one of the best performers over the next 10 years or something like that. I mean, it's like cyclicality there too, I guess. One thing I think was interesting, here you can see like gold miners bullish percent index posted by Bob Coleman, reading 3.7 out of an index of 0 to 100. that's pretty crazy. I mean, I like always, I don't care much for these charts per se. The only metric I'm sticking with, I mean, my whole strategy is just based on if something is cheap or not. If it's cheap, I'm a buyer holder. If it's not, I'm a seller, or I'm a seller if I find something even cheaper. That's it. That's all there is. I don't know what the Fed funds rate is, what the whatever technical and technical analysis says, yada yada. To me, it doesn't matter. I've been going about it the same way for 11 years. So far, so good. Every time I bought stuff that I thought was cheap, every time my portfolio was cheap and got cheaper in a correction, sooner or later the portfolio has made that all back and then some. So it's worked for 11 years straight without market timing, without trying to guess where the next move is in the gold price or the silver price or the juniors or the mining sector, anything like that. Just kept buying, holding cheap. 5% of the time, the portfolio making new all-time highs. 95% of the time, the portfolio is correcting or going sideways, aka making no money or losing money. 95% of the time from the last high. But then 5% of the time, it makes new net all-time highs. So basically higher tops, higher bottoms on average over 11 years. Without any market timing, without putting any weight really to stuff like this, except that, sure, it's obviously a good crutch. I mean, if I'm looking for confirmation bias to make me stay in the game when things are cheap, which I said before, I don't mind confirmation bias if it helps you make the right decision. And if stuff is super cheap out there, if you can, whatever, see a chart or somebody say gold is going to go to $6,000 in 2026, why not? I like to believe that. That makes it easier to have FOMO when everybody's panic selling. But obviously, sentiment is such a big thing. I mean, this is interesting for two reasons. A, we know that the market, I think, has been increasingly sentiment driven and irrational. And I mean, we've seen, I mean, just the fact that we've had kind of panic cascade selling, but of course, it's not necessarily just quote panic selling. I mean, a lot of people believe the U.S. government is in there fiddling with the oil futures. Why couldn't they fiddle somewhat with another alarm bell? I mean, to make it look like the war is actually going well. I mean, if gold shot up 20%, that would probably add some pressure to end the war quickly, for example. And then whatever margin calls. I mean, the gold market is a big market. Gold has done really well. Gold has done better than most stuff over the last 6 months, for example. So it might be, I mean, rebalancing, profit taking, whatever, and then add the fact, if you look at miners and juniors, whatever. Investors have never been, I mean, we shouldn't really call them investors, maybe speculators is a better name for it, have never been more short-term orientated, meaning less fundamentally driven, because, the gold mining sector is not that far off from still having like all-time high record profits. The fact that we can even have panic selling when that is still a fact is like, oh, the sector's has the best fundamentals it's had pretty much ever, or at least in the last, I don't know, 20, 30, 40 years or something. And the reading can be 3.7 on the gold miners bullish percentage index. I mean, that doesn't make much sense, right? I mean, I would expect super bearishness if the fundamentals were horrible, like gold miners going out of business left and right, etc. But I think it just goes to show that we can have super like apparently very negative short-term sentiment in a very positive sector. And obviously we see that, yes, in fact, we have had almost what looks like panic selling, but of course it's not only just panic selling. I mean, it's a bunch of reasons. Like everybody's a momentum trader, plus panic selling, plus algos, plus stop losses, plus whatever, plus the chaos around the world. So you have like probably 1,000 different reasons why people sell, and it feeds on itself because so many are actually momentum traders. So if you start something, it's gonna exaggerate it, and then the algos kicks in, which makes people even more scared, and especially even more people act like momentum traders and all that. So it makes sense. But that, I mean, this is the beauty of this sector. If we didn't have shit like this, why even be in the junior sector? This is exactly what you want to see. If I'm buying, I would much prefer the sellers to be obviously irrational. If I know it's sentiment selling and momentum sellers and algos and stuff, that's not smart long-term money. Those things are subsidizing value investors. I mean, the reason why we can, I mean, if you buy low cheap in this sector, the rallies that come after are ridiculous. It's like a black swan event. Why? Because they were driven down to such ridiculous levels because of momentum traders, market timers, panic sellers, algos, and all that. So they're creating these insane setups for value investors. If this wasn't a thing in this sector, and it's actually an increasing thing in the markets overall, um, we would eat less as value investors. It just feels good knowing it's like, okay, I'm looking at the price of the companies and the value they have, and everyone that's not doing that, or everyone that's selling is not even thinking about that. That's obviously what you want. So yeah, I mean, I've had actually a good time yesterday. I don't know how many times I laughed during the day. I mean, to be honest, a lot because of my own memes and stuff. But I really get a kick out of volatile markets. It's I don't know what. Maybe I was gonna say some self-reflection, but it's like I think, I mean, like yesterday. I'm listening to heavy metal and like very, let's say, music that gets my blood pumping and want me kind of go to war. That's what I'm listening on days like this because it puts me in the good mood where it's like, I mean, I like the phrase masculinity grows through challenge, and the more challenge I see out there, uh, I just have a tendency to like, I like a challenge. So this is fun to me. These days are fun to me. I did not enjoy the bull market that much, and to be honest, I would say like most of my portfolios underperformed GDXJ last year. So it's not like I felt that smart either, in a sense. But hey, I mean, if you're making money, you can't complain too much. But I was not loaded up on beta plays and marginal producers and all of that. So that comes with the territories. Like I tend to underperform when, let's say, the dumb money gets in, and outperform during, let's say, corrections and bear markets. And over the long term, I have more like, you know, lower highs than a full-on beta portfolio, but also lower lows. So it's more. I mean, I call it the all-weather approach in a sense, where it's like it's more fundamentally company catalyst focused instead of just, oh, I'm crossing my fingers hoping that dumb money or greater fools are gonna buy up the stuff I own. Whereas we see it's typically the most leveraged plays and the beta plays and the marginal stuff that does in fact go up the most from the bottom, because they all get bombed out because they're not good projects. But once it gets going, and then all of a sudden it's like, hey, this could work. People just push them higher than whatever a very high margin operation that's not that leveraged. So it makes a lot of sense. But you also see the flip side of that coin recently, where it's like I was discussing this with another investor. He's, I think, a really good, one of few actually good investors, and he's more of a trader than me. But he bought a bunch of low margin producers like a year or two ago and had a stellar 2025. Uh, and they really went up a lot. We're talking like from bottom to top, like 5 to 10 baggers. From bottom to top, obviously, almost nobody actually gets the bottom to the top. But a lot of them are also down 50-60% since the top. And that's the double-edged sword, where it's like my alpha focused portfolio did not go up that much. Not I mean, GDX was up. What was it, like 100? Was it 168 or something last year? My portfolio, most of my portfolios, I don't think any portfolio was up 168%. But again, during the corrections, it tends to not go down as much. But with these, I'm just trying to, because what I'm seeing out there, and I made a tweet about this first and foremost, that I've seen a lot of people, like yesterday, say, or the last few days, a lot of people are talking about how much of a cash position they have, how they're ready to jump in there, etc., etc. Obviously, in a downturn, people with cash look smart. You don't hear anybody talking about their cash positions during the highs. Nobody talks about their cash position. Almost nobody. Because I mean, it just this is social media after all. It's like everybody wants to look smart, and it's not like I don't want to be a hypocrite and say I don't want to look smart, but you get the idea. I mean, if you had 30% cash on the way up, and you're like, oh, nice, I missed missed making 100% on 30% of my portfolio. You're not going to brag about that. When it's going down, you can at least say, well, I have a lot of cash positions, so I'm not losing as much, and then also implying that, and when I deploy this, I'm going to make so much money, which somebody that's fully invested is not going to be able to do because they're already fully invested. Now I got off track again, I think, but I was going to say I've seen a lot of people say they are holding off on buying or thinking about selling or have sold because people are starting to talk about 2008 again, of course. And we're going to get to that later. And you see people again start talking about what if the markets crashes and all that. So again, like every correction and every bear market, people are fighting the last war. It's like the boogeyman is out there. Everybody, there's a ghost under your bed. So that's going to happen every time. There's going to be different excuses why people hold off on buying, etc., during corrections and bear market lows. Every single bottom has been different. 2015 bottom had a very different narrative than the 2008-19 bottom, and 2024 bottom had a different narrative. But still, at every bottom, people were talking about what if the markets crash. AK, it can always go lower. I don't feel like buying because I'm a value investor. So they come up with all these excuses. And one classic one is like, or now I'm going in circles again. My point was going to be all those comments. I have not seen, I don't know when the last time I saw somebody say, hey, I'm selling or holding off buying because of valuations. It just goes to show. A lot of people think they're investors. And let's call an investor classic value investor. Almost nobody actually is a value investor. At the end of the day, almost everyone is a market timer. That's just how it is. So if you find stuff out there, I mean, let's say you see stuff out there is trading like 25% of NAV or something. And it's a credible project, credible team, good backing, etc. What excuse on earth would you have if you're an actual, let's say, value investor not to buy that? On paper, it's selling for 25% of its value. That's ridiculously cheap. Right? It's like a built-in four-bagger or 300% upside to fair value. That's insanely cheap. And people still don't really buy that. It's like you can look at whatever. Any presentation of a credible junior. Look at the NPVs of their projects. They're so unbelievably obviously undervalued. Unlike 2015 when the projects had zero value. And still people are market timing. It's just unbelievable. So it's like, at least be honest with yourself that if you can buy a sector that's almost as cheap as it's ever been because you think cheap can get cheaper, you're a market timer. Don't try to pretend like you're not. But that's the thing. Everybody has an idea of what they are or that they are disciplined investors. But in reality, everybody turns into a market timer, pretty much. And of course, you're not a delusional market timer unlike everyone else. When the bottom is in, I don't know how often I hear this stuff. Oh, I'm gonna buy when it sells down. I'm gonna buy when the bottom is in. I don't think the bottom is in. I believe cheap can get cheaper. Yeah. That's market timing. Even if you pretend like it's not market timing, that is market timing. And it's just weird where it's like, wow, given how insane the returns tend to be from this in this sector of a bottom, and everybody apparently is very good at market timing with their big cash positions, and that they will know according to themselves when the bottom is in. Everybody got to be making 200% a year on average, which is obviously absolutely not true. Which means that almost everyone is a delusional market timer. I've given up trying to convince anybody. It's like it's actually okay to have correction, and I don't even try market timing because it's that hard and it's not actually needed. Case in point, 11 years. I don't think I've had a down year in 11 years, and I'm not even market timing. I'm just value shuffling. And still, well, okay, if you believe that, that's what I've said, I don't know how many times, like people believe that the reason they don't make any money in the junior mining sector is because they don't buy the bottom. How ridiculous is that? We can just look at whatever, it's like, what happens? This is GDXJ, but it's like, yeah, here you had years of buying a bottom to next top. Here you had years. Here you had years. And still people don't make money, but everybody is like, oh, the reason I'm not making money is because I'm not just buying the bottom. It's ridiculous. There's obviously no proof that could ever potentially be a case in a cyclical sector. Where it's like, how on earth is everyone so good at buying the bottom, knowing when the bottom is in, and still not end up making money over a longer period of time, let's say over 5-10 years? No, it's typically the ones with worst results that believe that their results are bad because they're not buying exactly there, and there. And also, on the topic of market timing, things can change pretty quickly, as we know. So let's pretend I have a big cash position. I'm a market timer. I'm like, hey, I'm gonna know when the bottom is in. That's what I've seen. When things settle down, when it's clear skies, that's when they're gonna be deploying. Okay. So how's that gonna work in practice versus my like, hey, the lower it goes, the more I'm gonna buy. The cheaper it goes, the more I'm gonna buy. I don't buy anything because it's going lower. I buy it if it's going lower and it becomes cheaper. That's it. That's the requirement. I don't go out and buy anything that's falling because there's a lot of stuff that's falling that's overvalued. A crap junior can go down 50% and it's still overvalued. A high quality cheap junior can go down 50% and go from ridiculously undervalued to extremely undervalued. Big, huge difference. My fear is buying something that should go down and stay down. If you're buying something that's actually cheap and this is your portfolio, every single correction is going to end up being a paper loss because it's going to come back because the intrinsic value is in fact higher. Anyway, so let's look here. It's like, again, we know now that people are talking about, as always, like I'm not deploying anything now. I'm holding off. I'm gonna market time, yada. I mean, how quickly can things change? Let's say you are one like, I'm gonna wait for a turnaround. That's when. If you're saying I'm gonna wait until the coast is clear when you've had, if it's falling like this, you're gonna wait for a turnaround. Okay, let's go back to the bullshit 2020 COVID crash. When they were just, cascade selling, panic selling, gap downs, etc. There was a lot of people that sold out. I mean, they were long up here because now it looked like an uptrend, and then sold out as it broke whatever these resistances, let's say. Because they obviously thought, well, the world is going to end, or we're going to actually enter a bear market because that means a lower low is in place. How did that end up going for them, you think? This was one of the 230% in 5 months. This is one of the most insane rallies in GDXJ in the last 20 years. But if we let's say we're here right now and people are saying, well, I'm gonna wait until the coast is clear, evidence of a turn is here. When would that be? When are you convinced that this is in fact a bottom here? When the sector is making an all new high and there's 36% left to the peak. When it's made at least like 1 or 2 consecutive highs, 86. Well, this closed with a 4 shooting star, so maybe you didn't buy that, you waited for this to actually close above that, so that's 65. And this is what happens if you were just catching a falling knife. So again, when is the coast clear? How much will you have missed? I kept saying this during the 2024 bottom. We're gonna know the bottom is in 6 months after it's in. Or let's look at a downtrend, for example. Or I guess kind of a downtrend. Okay, let's say you're convinced this is a downtrend. Okay. Well, then you're gonna, if you wait for a breakout, well, then you might be, I don't know, buying here maybe. So great, you had a 10% paper profit before it turned down and ended up being a loss. Whereas like if you just average down, at this point, at least all the buys in this black box here would be in profit. And some more than 10%. Some 4 times that. And on the topic of how, let's say, uh, quickly things can change. I mean, let's say here you have a downtrend. Okay, you're not buying that, yada yada. Then in 2 days it's up. Okay, all of a sudden every single buy in this box, if you just average down, would be in profit. But now if you're waiting, you bought in here, so you're starting at zero returns here. At least here you would actually be a bit in a profit, and it turned out that it's actually going to go higher. So all the buying for between January, so 2 months of worth of buying, is going to show a bigger profit uh, than this. And if you obviously just kept on buying every low, even better. If you just keep waiting for the coast is clear, whatever, it can again really come back, in my opinion, and bite you. Let's say, I mean, you could have bought here, for example. Okay, it broke out some trend line, but then quickly a paper loss, then up, but that's actually, just in time almost for a new top, and you're gonna be down 20% in the not too distant future. My point is, like, what's better offense and defense than just, in a sense, catching falling knives in cheap stuff? Because if you do this, I'm gonna buy in when it looks great. I mean, most of the returns are already gone. Again, when would you be convinced, if you're honest with yourself? Would anybody be convinced after a shooting star and a lower high that this is gonna go like that and not gonna go like that? No, I don't think so. And again, if you're waiting for, if you're now, let's say, a downtrend and you're still waiting for the I was gonna say coast to be clear, you're waiting for a bottom. I mean, you might as well be buying tops. It's like, yeah, this is a higher top, obviously. So if you're looking at this, and it's like, okay, this is a whatever cup and handle, or I don't know, maybe you could make it into a head and shoulders or reverse head and shoulders. All of a sudden, that's the buying condition. Well, congrats, you bought the top. And I was gonna say, I had some other. I was gonna say a good example, but my point is, like, when it turns from cascading selling. I mean, look, this was like kind of. I mean, it's not as bad as now, but still, it's like, okay, 1, 2, 3 trading days, and it's already up here from here. So all of a sudden, it's like everything in this blue box is in profit, versus, okay, I mean, a lot of the stuff here, I guess, is in profit already. But yeah, I can't. I mean, the more I see of this sector, I can't come up with a better. I was gonna say more realistic strategy than just buying dips. It's like, if you're wrong and it's not a bottom, you just bought high. If you're right and it was a bottom, let's say, I'm trying to find a good example. I mean, this is kind of a ripper rally, but again, you buy up here. Well, then you missed the dip here, all the dips here. So you're gonna earn way less from the dips, and you're gonna end up sometimes actually simply buying highs. Like, take this for example. Okay, you didn't buy during this action here. You're waiting again until the coast is clear, whatever that is. So let's say you got convinced that the coast was clear here because it's, higher high than here. And it's like, oh, I think this is the bottom. Well, okay, you're in the green for like a week before you're gonna be ready for the next what's that, like 2 years. or you're not convinced yet about that, so you're just like, okay, I'm waiting for this trend line to really break. Okay, now you're buying in here. Well, then even less green and more red over an even longer period of time. Whereas like if you're just a dip buyer throughout this whole period, your average would just go lower and lower, and you'd be up on everything at this peak. And again, let's say, oh, you want to see even more evidence that, oh, I think the trend is up. Again, nobody. That's the what people can't cope with in investing is paper losses. It's as real losses for most people. So let's say you wait for whatever this to happen, this level here to break, for example. Okay, now we had a breakout. Then you're buying here. Now you feel comfortable buying. Now you're sure that this is start of a, this was a bottom and this is an uptrend. You were green for 1 or 2 weeks, up 20%. After that, you were in for minus 60% over 2 years. So it's funny that almost everyone is delusional enough to think that they know when the bottom is in. They know when the breakout is real, or it's like, yeah, it's for sure the bottom. But what ends up happening is usually you just end up buying short-term tops. And the cases where it's like you might be right, so sometimes you're actually right. I mean, depending on where you when you're convinced the bottom might be in, you're still paying way high, or sometimes way higher than somebody who just averaged down the whole time. So in theory, it sounds great. I'm gonna know when the bottom is in. It's like, take this. I mean, already back here, people were screaming about a top. So again, okay, let's say you have your cash position here. You have 20-30% cash or whatever, and you didn't tell anyone about that maybe here, but down here, when people are getting convinced, the top was in here, then you're talking about your cash position and how you're gonna deploy it once you're convinced that the trend is not down anymore. So again, when are you convinced of that? Is it when it goes back up and makes a new high? Maybe you are. Then you at least have 35%. But then now you're convinced that the trend is up, of course. So you might be deploying even more, just in time for the next top. That I don't know how people are expect to make a lot of money that way. I mean, most people don't, obviously, but I don't have a single clue if this is the bottom or we're gonna bottom. Maybe we're gonna. I mean, the market absolutely loves to break resistances and have fake outs and stuff. Maybe GDXJ goes like that, which is kinda typical. I mean, break a bunch of resistance zone just in time for the bottom to be in, and again make a small higher high and then turn around. So the GDXJ, if anything, is like, it really, and typical of a bull market, it really wants to shake you out. It really I'm not using any stop losses. It really wants to shake you out. And it's like, I think you're fooling yourself if you think that you're going to be able to tell when the bottom is in. And again, the times you are wrong, you're going to be buying tops, short-term tops, paying higher price than anybody who just averaged down. When you're right, sometimes the market goes up so quickly that even if you're right, let's say you're just averaging down 246, and then let's say you bought a breakout whenever that is, maybe this is the breakout. Yeah, you missed 100% upside. All of that adds up. So it's like best case scenario in a sense. I mean, this is all else equal. Best case scenario, you're gonna miss a lot of the upside. Worst case scenario, you're gonna be buying a lot of tops and selling a lot of bottoms. I don't think that's gonna end up going so well. I am, again, in my view, every company I own has, in my base case is that, I mean, depending on if they actually have margin of safety, probable growth and all that. I mean, early stage exploration story, it doesn't have margin of safety or probable growth. It doesn't have a growth curve before it has a discovery, so that's more optionality driven, of course, where it's like, okay, in 3 years I might be down 50% or up 500%. But if we're talking like margin of safety plays with probable growth, high potential upside even, my estimation is that, well, first of all, price, the margin of safety might be that if we pretend that this is, I'm actually going to redo this. If we pretend this is the share price of a company, a junior, cheap junior with margin of safety, probable growth, high potential upside over the longer term, then I'm thinking that it's worth this much now. This is the margin of safety, which is obviously been going away from recently as the share price has fallen without much happening to the actual value. And then you have a probable growth curve that I think is like that. So it's going to be, the value is going to go up for every passing year that I can see now at least. I mean, let's say, they have 3 million ounces. I think it it could go to 4 or 5 in the next 3 years. So on average, let's say it adds on 700,000 ounces to the deposit, so it adds value over the next 3 years. And then, whatever, they might have some grassroots targets or something like that they haven't tested, but they will test, which might mean surprises along the way, potentially. Whereas, like, let's say they make a discovery and all of a sudden a growth curve starts from those targets as well. And again, also goes then with the longer the holding period, the more they can flush out the probable growth, and obviously the more they can test the potential upside, etc. So as the case is playing out, I'm expecting that the delta between the price I paid and the future value of the company, and therefore when the market becomes a weighing machine, the future price of the company is going to expand in time as the case plays through. So all of these corrections by default then are paper losses in my book. So every single time in my head I'm buying because it's going to go like this. And if we just count the margin of safety, it's going to touch the margin of safety. If it goes lower, it's going to go like that. If it goes lower, it's going to go like that. I'm not losing anything in my head long term, and every additional buy I can make in a cheap, undervalued story with a case intact and a long-term case, I'm going to make more and more from the lower the levels. And also when we go to like market timing, if something is ridiculously cheap, let's say something at 2.5 or 0.25 NAV, I mean this doesn't, let's pretend this is from this level today, You believe there's 300% upside within 3 years. I mean, give or take how long you think you need for the market to turn into a weighing machine. And of course, we don't know what the gold price is going to be. Gold price could be down in 3 years. Gold price could be at 10,000 in 3 years. We don't know that. We have to have some kind of compass. So if you're not buying that because like, hey, I think lower can go lower, okay, so you're saying what you're de facto saying is 300% over 3 years is not good enough for you. You're gonna wait because you think it could get to 400% over the next 3 years, and that, okay. But when that happens, you're probably fooling yourself if you think you're actually gonna buy that. I mean, let's put it like this. Go back to 2020, the 2020 crash. Let's do this instead. So here you think it's whatever. Yes, these are GDXJ. Let's say you think from here, you think the margin of safety is 200% sometime in the future. 1, 2, 3 years. Here, 300%. 400%. Let's make this one extreme. 600%. I'm pretty sure stuff went up. Some units went up 600%. So that's the future return in your mind. If you have an idea what you think that it's worth, if you have an idea what the long-term case is, risk reward, price versus value, and all that. But here's obviously falling. It broke resistance, and you're like, "Whoa, I'm holding off." Okay. Let's say, because we don't know what the future brings. Let's say it's like, oh crap, broke a ton of resistance. You're like, okay, rationally it should be like, oh, there's 200% upside there, but it's like, oh, I think cheap can get cheaper. Okay, what are you gonna think when this happens? Do you think that's a good time to buy? Okay, let's say you buy some, then that candle comes. Oh shit, I just realized it's not even showing. Oh, Christ. Sorry about that. When are you gonna feel okay buying this, if you're a market timer? I mean, the risk reward is going exponential as price is going down without value dropping. And again, a lot of people sold this because it broke a bunch of resistance lines. And then again, let's say let's say you're holding off again, holding off on your dry powder. You're holding off and you're not buying. You're on buying strike because it's going down. After 2 fat green candles, is this the time to buy? Okay, let's say you bought that. The day after, it opens up here, and within 3 days, you're down 25%. In 3 days, you're down 25% on your portfolio, on every single buy. What do you do then? Are you convinced at that point that this was actually that this is the bottom after seeing 2 green candles and it's making not a lower low, I guess, but you're down 20. You just get kicked in the absolute face within 3 days. It looks like you put in the worst buy possible. How are you gonna act then? How are you gonna think? Are you going to be convinced that this was still the bottom after this happens? And you just torch 25% of your portfolio on paper? And it closes down here, below this, below that. Are you going to buy more? Because you're that convinced all of a sudden this was the bottom? Or are you waiting for this to happen, where you have some kind of trend line, and then you actually are okay to buy? And this time, you're at least lucky, I was going to say, that this turned out to be the medium-term bottom at least. And let's say you're buying whatever. You're convinced here that this is the bottom. You're convinced about that here. You're looking at 85% return to the absolute peak, which you're not going to be able to sell at. But let's pretend you are. Compare that to some no market timer value investor who just, oh shit, it's cheap. I think I'm going to get 200% here. And then just plows in, plows in, plows in, plows in, plows in, plows in, plows in. And has his average, let's say, over this time frame drop to maybe here. This person is going to end up making more. And if he's value shuffling during this time, he's going to use his returns even more. And the things he might be value shuffling in, which was someone put in a market sell order, by the time the other market timer actually buys in and is lucky to be right, that stuff might be up 200% already. At this point, when this person buys in, there's not going to be panic selling. There might be, he's buying into panic buying, if anything. To me, something to think about, but I've given up. I'm not going to try to convince anybody why I think they're delusional with their market timing, and why I think there's a reason they're probably never going to have really good returns. And you keep hearing people say, you know, timing is so important. Timing is so important. Well, I have not seen much evidence of that. Given that I've never timed the market in 11 years, and the long-term portfolio has been compounding over, I think, 50% since the lows of 2016. But who knows? Maybe if I actually could market time, maybe the returns would be better. But hey, I don't expect to make much more than that. So that's I'm just saying, it's like, I don't want to tell anybody to, you know, what they should do. I'm just saying that the more I see in this market, the more I'm convinced, and on Twitter, the more I'm convinced that's like how many, and this sounds maybe like I'm sound like an asshole or arrogant, but it's like I'm getting more convinced that there's not that many people actually have, you know, whatever, a good long-term strategy. And also, what was I gonna... I mean, you can look at First Majestic, for example, as well. Same here with the, you know, whatever, false breakdown, false breakouts. Let's say you didn't average down here. You're buying when it went up. Yes, you were in profit for a week, and then then you basically you bought at least, you know, somewhat just before the high of the next year or so, and then you're obviously not going to be convinced about buying more until it breaks out again, and then you're going to be buying back here, let's say, which is, I mean, I guess it made a smaller high for a while there, but how convinced are you about this being an uptrend. Whereas if you were convinced you loved First Majestic, you thought it was cheap, you would obviously just be averaging down throughout this whole 2 year period. Basically, you have an average maybe around here, maybe with a big position. If you have conviction enough, you're already gonna be up. Let's say when this person buys in, you're gonna be up 28%. Might not sound like much, but let's look at the difference here from the top. And yes, I don't expect anybody to sell at the top. So from when he buys in, it's 269%. When this no market timing value investor who's has high conviction in First Majestic, he's got to add that up on 100% return. And then you're like, oh well, it's closer to in time. Sure, it's closer in time, but it's like if you get an extra 200 or 100% over 2 years, an extra 100%, is that bad? No. And obviously it's easier if you're playing with any type of size. And maybe First Majestic is a bad example because it's actually quite liquid. But think about any other junior when your portfolio is starting to grow and you just can't plop in full position in one day, where you need the actual accumulation phase so you can beef up the position, so you're gonna make better returns on more money. So especially I would say one thing I think one should consider is like, and I kind of talked about this in my PDAC presentation, where it's like, I want strategies that also caters to bigger money. There's a lot of people who are, let's say, low liquidity microcap pump and dumpers, for example. They're not that good at fundamental valuation, but they can see any liquid stock. They can, let's say, spin a good story. They can promise a 10 bagger. It can pop. They have their $10,000 invested or something like that. They make 30% on that and then find another one. Those are still small scale tactics. When you get some, if they get some real money, they can't do that, obviously. That makes sense, right? So wouldn't it be a good idea to actually also consider hey, I'm gonna get really good at strategies that also can cater to bigger amounts of money. And that usually then entails accumulation periods, because you cannot actually buy into whatever stock junior that just shot up, broke out, and you can get a full position within a trading day. I hope that makes sense. And again, just go. One thing I was gonna mention as well. I might come back to this. So it's like on the topic of fighting the last war. So I played around a bit with. I can't guarantee this is 100% true, but I tried to play around with, because everybody's talking about 2018 or 2008, where it's like, I mean, that's the go-to one, right? Where it's like, again, a big reason is like it can always go lower because there's also a 2008 crash around the corner. And I heard that in 2024, of course. I heard that in 2019 bottom. I heard that even during the lows of the 2020 COVID crash. I mean, that's literally why a bunch of traders slash investors, when is 2020? Yeah, I mean, here when it broke down here, for example, I mean, everybody thought the world was gonna end. Dow Jones was limit down 10% days in a row and stuff like that. The war did not end, proved to be a bottom, then went up, I don't know how much First Majestic went up, but 470%. But everybody's again, regardless of how low the sector is, regardless how cheap the sector is, everybody can find an excuse not to buy because there's always a. It could always be a 2008 episode. So, what I tried to figure out was like, okay, 2008. That was the sector had been rallying, and then 2008 came, brought it down. I don't know, 50% or something. And anyway, so I asked ChatGPT, it's like, okay, what was the margin? What was the and the closest? I don't think ASIC was a thing back then, but so it gave me total cash cost on an ounce. So total cash cost of an ounce back then was, what was it, like 400 something, I think, for Barrick, for example. And the gold price hit a low of $683 in the 2008 bottom. And then I tried to, imply or extrapolate. It's like, okay, so if we're using 2008 crash bottom metrics, what was Barrick's valued at? It's like how much EV per total cash cost margin. So if we used that valuation at the 2008 low, applied it to today's margins, and I think I had the updated one where it's like supposed to include, or some analysts tried to project at least what the higher oil and gas prices would do for the total cash costs, etc. I think it spat out like, or maybe this is actually according to Barrick, but let's say 1400. So if you used those metrics and on today's margins for Barrick is pricing in a gold price of $3,145, meaning that Barrick is currently more discounted on its margins than it was in the 2008 low. And then one could say, well, the margins are higher now, and obviously people would expect either the gold price to go down, basically that the margins to shrink, either costs go up, gold price goes down, or both. Sure, that's fine and makes sense because we have historically very high margins. But that also implies then that that is kind of discounted, whereas like Barrick is pricing in using 2008 valuation levels, pricing in a gold price already of $3,145 per ounce. That's kind of a margin of safety. One would think that, hey, 2008 crash bottom, sentiment must be really, really bad, so one wouldn't expect the highest valuation metric because greed wouldn't be a thing really. And still, Barrick appears to be much more discounted today than at the 2008 low. I thought I had some other one where. Okay, maybe. I think. Yeah. So here's one another example using $683 per ounce, 2008 gold price, and they had a total cash cost of $443, 35% total cash cost margin. That was 35.14% cash cost margin. To get same 35.14% margin today, basically the same profitability as the bottom of 2008. The gold price would need to go down to $2,158. Then Barrick would be on a total cash cost margin as profitable as it was back in the bottom of the bear market in 2008. And the dollar margin per ounce would be 758. And then we look at how much production their guidance is saying. So using same margin as 2008 with today's production, and applying the same 12.37 times EV total cash cost margin from 2008 bottom implies an EV about 28.9. So basically, if we were to replicate the 2008 crash lows conditions, gold would need, all else equal, and of course inflation goes up over time, but all else equal, according to this, and I can't 100% say this is an exact science, but according to ChatGPT, gold would need to go down to $2,158, and at that time, Barrick's implied EV, if it was valued the same as in 2008, would be around $30 billion. And I think Barrick is $64. So about, let's say, 50% decline. That's not too bad, actually. I mean, if we're looking, it's like, okay, to replicate 2008, all else equal at face value, and please don't take this as the gospel, gold would need to go down by 50% more from here. And then you would still only be looking at 50% down in Barrick. And another way to put it, that Barrick is already, with 2008 type sentiment, is already pricing in $3,150 gold. My point is that I don't think people really realize how cheap this sector is already. And with the latest ASIC estimates, which I saw on Twitter, I think Economic Alpha posted that, and I think the ASIC's estimates, including the oil and gas hikes, were around $2,000. So that's 2,700 ASIC margin for the large major miners on average. Gold by 2,700. In 2008, the total cash cost margin, which is actually lower than ASIC apparently, was only, what was it, $240. And this is, I think, again, a less conservative estimate than ASIC. So if ASIC includes more cost, or should include more cost, I mean, I know there's a lot of debate, like if ASIC is also a bullshit metric and yada yada, but it's like we have to work with something. Well, let's assume they're the same thing, that there's a lot of bullshittery in ASIC, for example. Still, it's over 10 times the ASIC margin today, or total cash cost margin today, 10 times. Do you think, are you seeing juniors with ounces in the ground trading for nearly 10 times the value of what they did in 2008 bottom? I don't think so. My point is that, yes, people can keep fearing a 2008 type scenario, but if you're not considering the fact that, let's say we're pricing in 60% of such scenario already, that let's say the sector is already pricing in that gold has already had a 2008 type price decrease, price crash to $3,150, how worried should you be about a 2008 thing happening? Another way to see it's like, yeah, we'll have a 2008 type crash if gold goes to $2,500. How likely do you think that is? If we're talking long shots, it feels like a 2008 type scenario is quite a long shot. And if that were to happen, what are the juniors going to price in? If they're not pricing in $3,000 gold now, they go down 50%. Let's say they're pricing in $1,800 gold, so $2,000 gold, just in time for the gold to bottom at whatever, $3,000, then goes up again, and you're starting off pricing in now whatever, $2,000 or $1,800 gold price. When that turns around, the next years the juniors are going to be up multiples and multiples from those lows. And that might, in that case, be starting at 50% lower levels from here. Do you think 100% return is going to be a problem in that scenario? No, they're probably going to go up 500%. Which goes back to my post I did on Twitter not too long ago, that I think it's a closed loop. I don't see any sell conditions appearing. I can't see them, at least. Could it happen? Of course, a meteor could strike us. I don't see any sell conditioning happening until we're up a lot on juniors. Meaning that every single paper loss that appears is a paper loss. Because I don't see a credible scenario where today's prices, and I'm talking the higher quality juniors that have real projects, where those prices, these price levels today, end up not being just paper losses. Meaning, whatever we lost, we're going to make it back and then some. To me, it's pretty obvious. I mean, that's why I'm, in FOMO mode already. And I don't care. I don't know when the market is bottom. I don't know if this is the low for GDX. I don't know if GDX is going to break this line before it goes higher. But I think we're around here already, let's say. Okay, that disappeared. Anyway, so I think that I have a bunch of probable, let's say 200-300% returners, like meat and potatoes in my portfolio, from these levels. And if they go down more from here, those, because the whole thing being that they're gonna hit margin of safety sometime in the future. It only means, not that I'm gonna lose money long term, it just means that they're gonna go up even more from lower levels. So it's a luxury problem, because in my mind I have this locked in. 200-300% over the next, whatever, let's give it 3 years, which would be an outstanding result over 2-3 years. The only question is, are there gonna be more paper losses or not until I get those returns? If it goes like that, I'm still making 200-300% over 2-3 years. If it goes like that, I'm still making 200-300% over the next 2-3 years. And that's of course why, if you're one of the majority who cannot stand paper losses, I don't think, I don't see how you're ever gonna make any money in this sector. If you're more focused on the fear of potential short-term paper losses more than the long-term gains, you're playing not to lose, but you're not playing to win. And that's why my slide, why my ending slide on my PDAC talk was, likelihood of success increases with willingness to look stupid. You don't think I'm looking stupid for being fully invested from here down to here? Or that I'm gonna look even more stupid if it goes down here? Of course, but I don't care. I want to make money. Me looking smart all the time basically market timing. You cannot afford to be wrong. If I was so obsessed about looking smart, never having paper losses, I would be buying every high and selling every low. I would be selling down here because it looks like shit is about to break out to the downside. I would whatever buy just every, let's say, big breakout just in time for a top. I would sell here, I would buy here, I would probably sell here, probably buy here because it broke out, sell here, maybe buy here again because this is still a higher top, sell here because it broke down, maybe buy here again because I mean, look at this. I mean, you could see I'm gonna get absolutely killed if I can't take paper losses. If I'm that obsessed about being in an uptrend, I'm gonna lose my shit. I might as well, I mean, stop investing altogether. If you're a whatever value investor and the price goes like that, you're sorry. You're gonna exponentially get more bullish the cheaper it gets. Your average is gonna go down. The future returns on your dip buying is also obviously going exponential. On par with the risk reward going exponential. And at every high, you're gonna be up a lot. Oh, okay, yeah, okay, this wasn't. I hope you get my point. So, hey, again, you can do whatever you want. I know this is not a sexy strategy. I know nobody agrees with me. I know that now, for example, everybody's chasing oil. Everybody, I mean, that's also why it's. I was about to sell the few oil stocks I had yesterday because I just can't help myself when I see it's like, yes, oil is high right now, but that's obviously political reasons and might be higher prices here to stay for quite some time. But I simply don't have the conviction. And there's projects out there which could absolutely survive $100 oil and $150 oil and are pricing in like that's already the case, and that gold is even lower. And they will still, be worth much more than the current market cap. So that's the margin of safety I see. So yeah, I mean, again, this is just the way I invest. This makes total sense to me. This has proven to work over the last 11 years. But of course, like 95% see it very differently, and that's fine. I don't care that much about looking smart. I actually want to make money, and so far I haven't seen anything that comes close to ramping up buying the cheaper something gets. So far over 11 years, in the end it's always worked out, but it could be sometimes 6 months or a year before the portfolio makes a new all-time high, but it still makes a new all-time high. So my all-in dip buying basically makes the portfolio go like this. And what, in my opinion, kills people's returns is that they think they can go like this without corrections, without paper losses. and that's why they end up buying every top, selling every bottom. So in reality, when you try to make your portfolio go like this, 99% of cases you're gonna have your portfolio go like this instead, which is kind of interesting. But that just goes to show it's like, and yeah, if you're not buying stuff that's cheap because you think it's gonna get cheaper and waiting for coast to be clear, you're missing out on the most obvious buys possible in a sense. I mean, who cares if this was a uh, downtrend? Like every single buy at this point, every single buy within this box would be in a profit. Here, every single buy in this box would be in a profit. Here, every single buy. So again, I reiterate my question: how much market timing do you actually need? This sector is a cyclical sector. When it's low and cheap, the risks are to the upside. That's it. Okay. Thanks for listening. If I talked about any companies, assume I own them. Some might be banner sponsor. Not investing advice. You do whatever you want. Again, one caveat, I guess. I mean, I'm not expecting most people should not be investing like I do. I don't think people would probably not be able to sleep being fully invested in a sector that goes like this. I have an insane tolerance for volatility. I don't have insane tolerance for risk because I don't feel like what I'm doing is that risky, but I still see my portfolio and therefore my net worth gone down 30 to 50% multiple times since I started in 2015. And yeah, I mean, there's quality of life as well. I mean, most people should not do this because you're gonna end up being too emotional. But I'm just saying, it's like even though everybody on Twitter and their mother is saying that how important market timing is, you at least have one example, me, that I haven't done market timing in 11 years and it's worked out quite well. Thanks for listening. Bye bye. Not investing advice.